Siddarth Bhamre of Asit C. Mehta. Siddarth, lovely to be chatting with you. Not a great Friday morning. In fact, all of us will be waiting for the markets to shut and look forward to the weekend. Given the kind of week that we are having now. But how would you navigate this leg of the sell-off? Because we've seen 5 straight series of losses. March series hasn't started on a sanguine note. What should the strategy be now?
Good morning, Nandita. Well, markets are just one part of life. It's a great morning, so let's be cheerful. And if you look at from a long-term investor point of view, then such kind of markets are delight because it offers quality names at desirable valuations. So it is how you're seeing market and what's your time horizon makes you feel a bit jiffy or excited in this market. I'm quite excited in this market.
Well, so yes, what would you be buying then, Siddarth? If you are excited, where would you be looking to hunt for bargains?
So my compliance doesn't allow me to buy personally, but definitely we are going to dwell more into the sectors and stocks which we are liking. But purely from market perspective, Nandita, if you look at the seasonality, then yes, month of March has a better probability of giving a positive return. In fact, on your own website, there's a good seasonality chart on how Nifty moves. So 68-69% of time March month has been positive. But then these numbers and these seasonality charts look great when you are looking at them and forming positions or investing in a normal market situation. And we all can agree to this that this is not a normal market situation because you were talking about 5 months of losing streak, and this has happened first time in 29 years. So should we give weightage to seasonality is one question we need to ask. But then a long-term investor doesn't look much into seasonality charts and invest. I feel there is still some pain left in this market, and especially in mid and small cap segment. And my prime reason for that is that a lot of people had invested in mid and small cap funds last year. Most of the major inflow which came into mutual funds last year was in mid and small cap schemes. And we haven't seen any meaningful redemption yet over there. It's been like, if you look at now, more than 18 months SIP return in a large cap fund would have been giving now a negative return. I understand you don't do SIPs for 2 years, but then retail investors, bulk of money which has gone into mutual fund, they chase performance and seldom look for outperformance. So I expect further weakness in mid and small cap segment, and would be very, very stock selective if I want to be in mid caps. Large caps, there are some pockets where we are seeing value emerging. There are some pockets where we are seeing that this selling is not impacting, and that is where we would like to position ourselves. So I'll be very nimble-footed in this market. Not get excited because certain levels have been breached and now stocks are looking attractive. You have to see valuations from a relative perspective. What I'm trying to tell you here, Nandita, is that because your five-year average valuation is looking cheap, doesn't mean that stock is actually cheap. We have to go back 10 years, 15 years in such kind of markets and see that where valuations will find their feet and then invest accordingly.
All right, now don't get too excited by looking at the stock prices. Be nimble-footed and of course do your research before investing in stocks. But let's talk about particular sectors, specific sectors. And one sector that has been hogging the limelight for all the wrong reasons is the cables and wires segment, right? Because of course Ultratech is looking to disrupt this space as well after the Birla Group has already disrupted the paint space. We also saw how things really panned out there. Asian Paints and other paint makers have seen a fair bit of correction ever since this competition came in. But here Ultratech has just about mentioned now that they will be coming into this segment, and the plant will only be commissioned in December 2026. But we saw such a knee-jerk reaction on stocks like Polycab, Kia Industries. Do you think it was an overreaction? Do you think there is a lot of pessimism because of what transpired in the paint sector? Is there a parallel you can actually draw, and do you think it's an overreaction? Your thoughts on this entire issue?
Well, it's an interesting development which is happening in this space. There are few differences which I want to highlight between paint space and cables and wires. That paint space was going through consolidation a weaker period, and cable and wire sector that's going at a healthy double-digit growth rate. So the two sectors are in different situations. So if somebody is in really critical situation and then you beat them down more, chances of failure are quite high. But if somebody is doing great and you bring some hurdle, it is quite possible that there might be a pause or there can be some slowdown in pace, but the chances of failure are far less. So I believe there is a underlying difference between paint sector and cables and wires because of the growth rate and the margins of the business, plus the quantum of investment the new player intend to do. So I will not say that it's an overreaction because see you have to see it from total market context. Now very few spaces are there where correction has been less, there has been earning visibility, and everybody is trying to hide there. And this space was one of that space, in mid and small cap segment. And all of a sudden, even there, you are trying to shake things. So there would be a knee-jerk reaction. There will be funds who are hiding in this space, getting jittery that this market is bad, and now you should move out of this space also. So it is not an overreaction. Looking at in totality, how to approach this space, I think looking at market situation, looking at the kind of investment Ultratech is sounding, I believe there can be some more downside from current levels in this space. Also, one has to understand that this space was demanding valuation on trailing basis above 45-50p, which I feel was slightly on the higher levels, but a lot of market participants would justify because the growth rate has been higher, so they will command higher. But now market has come down, market valuation has come down, the competition is creeping in. So there will be some amount of derating in valuations, and that is getting reflected in price. So I believe there is still some more downside, but this is not a space where you should be shying away from medium to long term. If there is a correction of more 10-15%, which it looks quite likely, I think some of the names in this space like Polycap, KEA Industries, these are some names which one should think of investing at lower levels.
Right. So the correction that we've seen, and if there is more 10 to 15% correction from current levels, these would look as attractive opportunities to invest in. But let's talk about the auto space as well. When you talk about competition, this is one sector that has been facing the heat or the heat of anticipated competition from Tesla, right? So we've seen stocks like M&M, Maruti, Tata Motors see a fair bit of correction. How would you approach this space now? Because we've seen a fair bit of correction in these names, and we also have auto sales figures coming out over the weekend. Passenger vehicle has been in a spot of bother, right? That segment in particular. So looking at the correction, do you think valuations justify that now, or would you say that since there's so much anticipation of competition here, two-wheelers pose a better opportunity given the fact that we are witnessing rural demand as well?
Right. Firstly, on Tata Motors, I think Tata Motors has been underperformer for various reasons, and even from auto numbers perspective, my analyst said that be it PV or commercial vehicles, Tata Motors is going to be laggard, and I believe that is getting reflected in stock prices. Yes, you are right that one has to be more bullish on two-wheeler space, and especially some of the names like Bajaj Auto, TVS. In fact, this month we are expecting even Eicher to do well in two-wheeler space. Hero MotoCorp would have probably sluggish numbers, but from valuation point of view, Hero Moto is looking attractive, but it needs to show some support from monthly numbers perspective, which are missing right now. As you mentioned that the rural economy is doing better. The consumption power may not be very significant in urban areas, but then rural areas we are seeing uptick, and that is getting reflected. Stocks like Bajaj Auto, which also have good share. In fact, 50% of its revenue comes from export. and the markets which it is catering to, especially LATAM, is looking great. So in two-wheeler space, we'll be more interested than PV. Maruti, yes, it's looking attractive from valuation perspective, but I think monthly sales numbers are not giving us a great confidence right now to talk very bullish about it. But some more correction, and we'll be interested in PV segment, especially Maruti. Honda is not doing that great as far as monthly numbers are concerned.
All right, that's about the auto space. Any other sector that you would recommend now? In fact, even if you can highlight some stock ideas from your coverage universe that's looking attractive now after this correction.
Well, one space which my alternate research team is quite bullish on recently is FMCG space. They are expecting that the correction in FMCG is more or less done. They have come out with a wonderful report with three stock ideas in that. They're bullish on HUL, ITC, and Nestle, and they have their own reasons. But from fundamental perspective, HUL now is available on trading P 40 times and. I don't know when last time, we have seen, HUL trading around this 45, 50 times P multiple. I understand there are challenges, but then sometimes you have stories, sometimes you have valuation. That's my, go-to dialogue when I talk about valuation. And also, Nandita, our market where, money was chasing growth, will now move in a territory or in a phase where money will start digging value. So this people need to keep in mind rather than chasing growth stocks. The new funds or funds which are trying to take contra call will look for value, and that is where probably some of these FMCG names would come into play. So that's the theme which we are advocating at this point of time. Some of the names which you are liking, recently we came out with one of the, in fact, it's an auto hang company. We came out coverage in a mid-cap segment, Gabriel India. And if you look at mid-cap stocks and look at the stock price of Gabriel India, it didn't correct much. If I have to quickly wrap up about this, then it is into, suspension, but it is pouring into high margin business, which is sunroof. It has various OEMs as their client, and it's doing pretty well. And valuation-wise, also quite attractive. They have a target price of 605, which gives decent 25% plus upside from current levels. So Gabriel India is one of the stock which I would recommend from our universe.
All right, Gabriel India, that's the stock recommendation from Asit C. Mehta. But with that, Sid, we're running out of time. Would like to thank you as always for taking our time and joining in. Always a pleasure chatting with you, and I look forward to more interaction in the future as well. Have a great weekend.
Thank you so much. Thank you. Wish you the same. Thank you.
Thank you.